These results appear to be broadly in line with consensus forecasts. What's your take on them?
Well, my take is that 2016 was a transformational year. We made an acquisition of a company which is now 80% of our total business. And secondly, what happened in 2016 is that all three businesses which we now own showed good growth of between 18 and 19% of the loan book. That's very satisfactory. The final point I would make is that actually the businesses made almost £20 million in normalised profits pro forma during the year 2016. So we have a good, profitable, growing business.
Everyday Loans appears to be performing well across a range of metrics. What are the key drivers behind this?
Well, when we acquired Everyday Loans, which was in April of 2016, we immediately started a growth programme. And the first thing we did was to start branch openings again, and we've opened 5 branches in 2016 on top of the 36 that were already there. Secondly, we also introduced new loan products, particularly those with higher margins. So the margins actually increased the yield from 51 to 56%. Those are the two prime items which have really driven the very satisfactory results from Everyday Loans.
How were these results affected by the additional costs of new agents and increased impairments generated by Loans at Home?
We acquired Loans at Home in 2015 and saw a very considerable market opportunity for growing the company, and consequently brought on 40% more agents into the company to lead the expansion. The costs of those are clearly included in 2016. The second cost, which really affected the results, was impairment, and that was as a result of us trying a number of alternative different strategies. Some of those did not work and created higher impairment. One of them worked extraordinarily well, and that is the strategy which we're now following.
Does this, though, question your strategy for the businesses to deliver 20% loan book growth?
It certainly doesn't question the strategy. We remain confident that we can deliver overall 20% loan growth, which is part of our target.
Last time we met, you were executive chairman, and now you're chief executive. Why the change?
Well, when we floated the business with an IPO in 2015, we were a cash shell, so there was no need for a chief executive because there weren't any businesses to run, and I was executive chairman. Now we have 3 cogent businesses and there is a need for a chief executive, and clearly as founder and with 35 years lending experience, I was the appropriate candidate to take on that role, and Charles Gregson, with huge experience being chairman of a number of companies, took over as chairman.
The public, the media and the FCA are all very interested in high-interest unsecured lending providers at the moment. Are you concerned that future regulation and potential interest rate caps could affect your growth potential?
No, not really, and the reason for this is as follows. The FCA is carrying out a review at the moment into high-cost short-term credit, and there is an interest rate cap in place which doesn't apply to any of our 3 businesses. If it were to be applied to all 3 businesses, we still operate well below the rate cap. So the rate cap is not a concern. The second point which I would make is that we actually pride ourselves on being best in class in terms of regulation and compliance. We always have been. Businesses which I have previously run always have been. So that in fact is a competitive advantage as we see it. Many of our competitors, particularly smaller ones, are struggling with the rules and regulations that have been imposed by the FCA.
How, though, do you protect your businesses and your corporate reputations from being tarred with the same brush as other less scrupulous lenders?
Well, we have the very highest standards of regulation and compliance throughout our business. This reflects the fact that all of us on the board have worked on businesses in the same industry and have achieved this before. So our reputations and what we actually carry out is the very highest standards. This means that agents, employees, customers want to come and work for us from companies outside, and that is because we have a first-class reputation.
The shape of the UK's home-collected credit industry is set to change further with a significant restructuring of your largest competitor. How do you plan to respond to this?
Exactly what we're doing at the moment, which is to continue to grow our home credit business, and we're doing this by selecting and taking on additional really good quality agents who have considerable experience and who also bring customers to them who have been using home credit for quite a number of years. So it's business as usual.
There's a lot of uncertainty surrounding the implications of Brexit, but current trading appears to be solid, and you say that your customers are well placed to withstand inflationary pressures. Can you elaborate on that?
Yes, I can. Our customer base has actually done rather well over the last few years. Since 2014, their incomes have actually increased by over 9%, and that compares with a much lower percentage for the UK population as a whole. So they are comparatively rather better off than they were. Now, the Bank of England is suggesting inflation for this year of around 1.9 to 2%. But having had a 9% increase in incomes, our customers are well placed to take this into their income and expenditure calculations.
Your proposed final dividend is 0.9 pence per share, making 1.2 pence for the whole year, and it's well above consensus expectations. Why so much?
It is because we have three businesses which are growing between 18 and 19%. We've delivered good results in 2016. We made a good start to 2017, and that all adds up to a good dividend.
As always, we have a variety of numbers to look at in the results. Which are the ones we should focus on, the key numbers in your view?
You're right, there are a lot of numbers in the presentation and the results. The numbers that I focus on particularly are the normalised results, so that it excludes accounting adjustments and other noise, as I might put it. And I also look at pro forma results. We've only owned Everyday Loans since April of last year, so I look at the results from the 1st of January, assuming we'd own the business. And on that basis, we made £95 million of revenue, £20.5 million of profit before operating profit, that is before excluding agent support costs, and that generated earnings per share of 3.4p, and on that basis we're paying a dividend of 1.2p if approved by shareholders.
How is the second half delivered in comparison with the first half? It's normally the stronger half in this market, isn't it?
Yeah, the second half has been stronger than the first half, so we made £11.8 million in the second half compared to £8.7 million in the first half, again at that same normalised operating profit level. Excitingly for us, that growth was driven by Everyday Loans, which is not a seasonal business. Our home credit business is quite seasonal, so the second half is usually stronger than the first half. Everyday Loans, the growth is the fact that the business has been growing fast, 18% growth in the loan book year on year, so that organic growth has delivered a significant increase in profits. The home credit business was actually relatively flat first half versus second half, as the actions we took to reduce impairments, control the growth somewhat, meant that the growth in profits was not big half year on half year. As we look to next year, we expect to see that go back to the more seasonal pattern of a stronger second half of the home credit business. Trust 2's profits actually went backwards slightly in the second half of the year as we invested substantially in the business, putting the infrastructure in place, and that's what will enable us to deliver the growth well into 2017.
The Everyday Loans branch network increased by 5, and you have plans for 12 more this year. Do you have a target number in mind across the country and a planned time period to achieve this?
The 41 branches we have currently will go to 53 if we're successful in opening our 12. We've already identified 10 of the 12 sites for the growth of the branch network. Our plans going forward are to open 10 to 12 a year. We think that's quite realistic. And the team that run the business ran a branch network of nearly 100 when they were at City Financial. So we think there's substantial growth in that business in terms of branch network.
Are you confident that you now have the loans at home balance between revenue and profits under control? And how should we expect this to affect performance this year?
We've made quite substantial changes to the business. We've tightened up the credit scoring, we've refreshed the management team, and we've really focused on hiring only very experienced home credit agents. Based on that, we're very confident that we have the balance between impairment and growth in the right place, and we expect to see a substantial growth in profits into 2017 in that business.
Trust 2 is showing potential. Given its small size, lower percentage cost and impairments model and large market, don't you have more aggressive growth targets for it than the overall 20% annual loan book one?
We spent quite a lot of time in 2016 investing in the business, building out the new website which launches fairly shortly, refreshing the product set, and we think actually there is potential to grow faster than 20%, and that's critical as we move to become the clear number 2 in the marketplace. So I think as we move through 2017 and 2018, we're likely to see growth above the 20%.
With your plans for growth, can you talk a little more about how this will be financed?
At the end of the year, we had £5 million of cash on the balance sheet and nearly £10 million of undrawn facility. We also have the 20 million accordion, which we've not exercised at everyday loans. So that combination sets us up well for financing through 2017. And as we move into the second half of 2017, our plans are to look at alternative sources of financing, and the high yield bond market would seem to be an obvious place to look. So we think we're well placed to fund the growth of the book through debt, and we don't see any need to come back to shareholders for equity to fund loan book growth.